Hello and welcome to the virtual enrollment meeting for the 4Rivers Smokehouse 401k plan. My name is David Witter. I am the investment advisor helping John and Monica with the plan and with 4Rivers and be your resource for portfolio design, and we'll get into more about enrollment and how to utilize this new 401k plan. So let me share with you very quickly the agenda. One is, why do we need to start saving today? Like, why do we even need a retirement account? Second is, how much do I need to be saving and investing? Three is, how do I work with this retirement plan, get money invested there? What are my investment options? And last but not least, how do I get started? So why do you even need to consider saving for your retirement years? You can see here that Social Security only covers a portion of our need once we hit our retirement years. With Medicare, there's question marks with that. Will it be the same in future years as it is now for those who are already on benefit? So we'll be required to take on more of the responsibility for our medical costs as well as our retirement income costs. Also longevity. So the good news is we're living longer, but the bad news is we're living longer. I'm blessed to have 4 grandparents that lived into their 90s. In fact, one of them's still alive and she's 97. And that's just a situation where with that longevity, if you are going to live into your 90s, which statistically speaking many of us watching this video will, then what that means is if we are unable to work beyond, let's say, age 62 or 65, that means we have 30 years that we have to live on our savings and investments. So here's another reason why to save is there are tax advantages. You can see in this example where this participant deferred or saved into the 401k plan $2,400, and it resulted in a $600 tax savings for deferring that money into the retirement plan instead of taking it in their paycheck. This is very important, especially to our viewers that are younger, in their 20s and 30s and even 40s. In this example, we can see that Lisa loves to save is putting $500 a month into the 401k plan. Notice at 25 years out, now during that period of time, she's saved or contributed $150,000. But notice how much she has accumulated in earnings or gains. That same amount, or over $150,000. So when you add those two together, she's more than doubled her money in that 25-year period, and that's assuming a 5% growth rate. Obviously, if you're getting a better return or a better growth rate, this is even more pronounced. Now, what's really important here is if you wait just 5 years to start saving and investing, do you lose that first small bar, or do you lose that big $300,000 bar? The answer is you lose the back end. You lose the $300,000. So what I mean by that is if you wait just 5 years to start saving and investing, notice that your total pot drops from $300,000 to about $208,000. So it's $94,000 less. That's the penalty for waiting 5 years to begin saving and investing. So start now and start early. So how much do we need to save and invest? This is a quick example. Let's assume that you need $50,000 to live on. You're getting $20,000 from Social Security. That means the $30,000, the remainder, that difference, where does it have to come from? It has to come from your savings and investments. And for how long? However long we're in retirement, which could be 20 or 30 years. So the safe amount we can withdraw from our portfolio and have our money last as long as we do in retirement is 4%. So if we need to draw out $30,000 and we divide by that 4% number, that's the same as multiplying by 25. So 30,000 times 25 means we need $750,000 saved and invested to be able to generate that $30,000 a year of annual income. Now I'm sure many of you are saying, whoa, that's a big number. I got it. My wife Katie and I are in that same situation. We're 37, we got 25 years left in our careers, our working careers, and our number to set aside is big because we don't think Social Security and Medicare are going to be available for us. Stay committed, start now, stay with your investment practices. And I love that last question there. When is the best time to plant a tree? Now. It might be 5 or 10 years or 15 years before you're going to enjoy the shade that it produces or the crop that it produces. But start now and get that process going. This is another quick example. The more you save each month, you can see that it dramatically increases the amount that you end up on your big pot at the end. So this is a pronounced difference between saving $100 a month and $300 a month. You can see that it's 3 times the amount. So number 3 is, how should I invest my savings? If you've been in a 401k in the past, this may look familiar where you have the investment options. Notice though we have 2 categories here. The bottom are individual mutual funds that if you want to manage the portfolio yourself and build it yourself, you can select what percentage you want to go into those funds. But I call your attention to the top where it says model portfolios. This by far is much more common what our investors and our 401k plans tend to do. These models is where we construct those portfolios for you, and it'll give you the opportunity of having it done for you, and then we rebalance those portfolios as new money comes in to whichever one you pick. Now your next question might be, well David, I see there's 5 model portfolios. How do I choose which one of those is best for me? And we will answer that in just a moment. This is a great graph showing why we build the portfolios the way that we do. These are what are called dissimilar price movements. Or the way to think about it is, if you had 2 investments in your portfolio, notice when A is going up, maybe B is going down, and when B is going up, maybe A is going down. But when you add the 2 together, you get the portfolio line, which is much smoother. That's the exact same concept of why you want to have different components to your portfolio, and that's what's constructed in those model portfolios for you. We also, as I mentioned, rebalance for you, so we will automatically buy low and be selling high when there's a rebalance that's needed. The best way to think about this is, if your $100 goes into your account, whatever is low that month, like maybe stocks had a sell-off, we'll be buying more of that, whereas maybe bonds went up or stayed the same, we wouldn't be buying as much as that. So we're always buying what's lowest to rebalance your portfolio for you so that you don't have to. Number 4, what are my investment options? So you can see here are the 5 model portfolios. There on the far left is bonds, which is the most conservative, going all the way out to the right, which is aggressive, which is 100% stocks. And this shows you the components of where that money would be allocated between the different portfolios. Also notice down at the bottom it references the exact mutual fund that percentage of the portfolio would go to. So we're basically using those mutual funds components and building the portfolios for you. Alright, this is where we get to which one is best for me, David. How do I choose what portfolio is the best for me? I'll start with the top table, which is the periodic returns. Go over to the 10-year column and then come down. So we'll start with the bond portfolio. Over the last 10 years, what did that conservative or that bond portfolio do per year for those 10 years? Yep, if you answered 3%, roughly, that's exactly right. Now let's say that you wanted to go a little bit more aggressive. Let's slide down 2 rows to the balanced portfolio. And the last 10 years, what did the balanced portfolio return? That's right, at roughly almost 6%. If you slide down to the 5th one there, which is the aggressive portfolio, and you look at the 10-year number, what did it return during that 10-year period, annualized? About 8%, or a little bit north of 8%. Now, raise your hand if you think that 8% is better than 3%. Obviously. But there's no free lunch. Just like when someone comes in to eat there at one of the 4Rivers Smokehouse restaurants, they can't get their food without paying. In investing, if we want higher returns, we have to pay with downside risk. So let's move to the lower table, the annual returns. Slide over to column 2008. You can see the bond portfolio in 2008. What happened? What did it return? Roughly 0 or 1%. So it didn't lose money, but it had a slight gain. But if you look all the way down, let's go to the aggressive portfolio, because maybe you thought that 8% rate of return looked great. Well, look in 2008, the aggressive portfolio lost 40% of its value. So let's make that real. If you had $1,000 invested in the account and it dropped 40%, that means it went down to $600 during the course of the year. How would you react if you opened up your statement and saw that pronounced loss? If you would panic and want to go like sell out and get out in cash, not the right portfolio. You need to go more conservative. Look at the growth portfolio. 2008, it lost 29%. That means your $1,000 fell 29% or down to $710. That's very different than falling to $600. Psychologically, you may feel more comfortable with that. Some of you, though, may still be thinking, if my 1,000 fell to 710, I still would panic. If that's the case, move up more conservative again and go to the balanced portfolio. The balanced portfolio lost 17%, which means your $1,000 fell to $830. That may be appropriate for you. So address those numbers. See what you're most comfortable with, because you cannot time when to get in and get out of the market. It's impossible. So you need to be thinking with, what downside risk can I stomach emotionally? And based on those percentages, use the account value which you think you would have. And then say, all right, I'm committed to, let's say, the balanced portfolio or the growth or the aggressive. And then start contributing and stick with your plan. Even when things get bad, you got to be willing to stick with that portfolio that you chose. I will point out, if you have $100,000 in the account and you have a 40% fall, now $100,000 falls to $60,000. So the more money you have in the account, the bigger those dollar amounts. But it is a percentage, and you do get a higher rate of return by taking that downside risk. Last but not least, how do we get started? All enrollment's online. You go to www.webaccountlink.com. Just type that in. Once you get there, they'll ask for your social and your PIN. Your username is your social security number without any dashes. So just put in the 9 digits, I think? Yeah, that's right. And then for the PIN, you're putting in, it's a temporary PIN, you put in the last 4 of your social. So that's the temporary. Your social security number with no dashes, that's the username, and then the PIN is your last 4 of your social. Once you get in, you'll be asked to set up a new username and a new password to help protect your privacy. Do that. There's some considerations on that. I have that here on the screen. And then they'll ask you 4 security questions in case you get locked out of your account. Once you've got all that established, then you elect the percentage you want to defer into the plan. This can range from as little as 1% up to, I guess, as much as 100% if you wanted to defer all your pay. That's probably not realistic. But let's say you choose 6%. That means that, let's say you're paid twice during the month, so it's $500 on the 15th and $500 on the 30th. Then 6% of that would be $60 or $30 per paycheck. So that 6% is drawn out of your paycheck. You wouldn't even receive it, and then it goes straight into the 401k plan. And remember, that's tax-free. Like, it doesn't have any taxes taken out. That money goes into that 401k. It's tax-deferred, and you don't get taxed until you take it out in retirement. Once you've chosen that, let's say 6%, you cannot change it again until quarterly. So let's say July 1 or October 1 or January 1 or April 1 is when you could change or adjust that percentage that you're deferring into the plan. Once you've decided your deferral amount, then you choose how to invest the options. So let's say you choose the balanced portfolio. You would just put 100% next to the balance, and that means 100% of your deferrals would go into that particular portfolio. Confirm the entries, and then number 7, don't skip over this, beneficiary designations. Whoever you name as a beneficiary on this account would get the funds should you pass away. If you don't name one, which is a big no-no, if you fail to name a beneficiary, that account becomes immediately taxable, and the state would then decide who gets that account. It may be somebody that you don't choose. So make sure you name a beneficiary. Don't skip over that step with your 401k. So in summary, questions and answers. Again, the website to get enrolled, get set up is webaccountlink.com. Once you go there, you use your social and the last 4 of your social for your PIN. Get that established. If you have any trouble at all enrolling, or you have questions with the website or getting your portfolio selected, like once you're in the actual account, you can call PCS, which stands for Professional Capital Services. They're our partner in administering the plan. And there's the number there for them. And then last but not least, if you have questions about your portfolio, what portfolio is most prudent for you, whether it be like the aggressive, the balanced, the conservative, the growth, any of those. If you have questions about that, you can email me or call me to get those taken care of. One last thing to leave you with is John and Monica have really been good and generous with helping to pay for a lot of the upfront costs of launching this plan. And in my experience with startup plans like this, that, like I said, they've been very generous with this to make it low cost. Secondly is on the investment plan options, you'll see, like for instance, the balanced portfolio is about 30 basis points or 0.3%. The national average for mutual funds is about 1.2%, so it's about 1/4 the cost for that. So again, enjoy the plan, get enrolled, get started now. Even if it's just 1%, just get something started. And if you have any questions, here are the resources to reach out to. And I wish you the best of success.